Hello, everybody. So it's earnings season, and two stocks that I own reported their Q3 earnings. And I also want to talk about Enphase. Enphase, of course, used to be a channel favorite way back in the day. And Enphase also reported its earnings. I don't own Enphase anymore. I sold it towards the end of last year. So let's get started. Let's talk about TransMedics. So TransMedics, I've updated the valuation of TransMedics. TransMedics just went below 0.3 on enterprise value over gross profit over revenue growth, 0.29. I consider this to be inexpensive. TransMedics achieves a rule of 40 at 60, almost 60. So I consider this very good, right? 50% better than the 40. So that's pretty good. This stock is cheap. The stock is dropping. I'm not showing the chart right here, but the stock is dropping 8 to 9% at the moment. And that's because the market likely forgot that Q3 is a historically weak quarter for organ transplants. Why? Why is it a weak quarter? Because Q2 captures the summer. The summer is peak driving season, and unfortunately, accidents happen during the driving season. So that's always why you see this seasonality between Q2 and Q3. You can see in 2024 it was the same thing. You had exactly the same seasonality between Q2 and Q3. Keep in mind that TransMedics doesn't really have a full control on their revenue. The revenue is driven by unfortunate accidents. That's a lot of accidents that drive the revenue, but they're still growing. They're growing very fast. In fact, they are so confident about how fast they're growing that they're updating their guidance by a whole percent, guiding between 595 and 605 million. This is a company that consistently updates the guidance. In my measurement, I have it at 44% next 12 months revenue growth. I'm using the analyst number. You may think it's a little optimistic, maybe not. Anyways, it's not that far off. It's well over 35% is what they're going to grow in my view over the next 12 months. 44% is what I have it in there. If you had 35%, you'd still get a pretty cheap stock. The company is now making a bunch of money. They have 21 aircrafts. They make a lot of money with these aircrafts. They had to buy the aircrafts in order to own entirely the value chain of organ transfers, and most of the money that they make is with liver. Liver is most of the revenue when you have heart. Lung is not really growing very fast, but liver is really the cash cow for them. So steady Eddie company, they still have their goal, their 2028 goal of 10,000 transplants, which means that this is a company that in my view could be a multi-bagger once again. I'm happy to own it over the long run. I consider the minus 8 to 9% right now to be a minor hiccup because the market is just so short term and forgot that there is a seasonality in how this revenue is generated. And that's just the way it is. Okay, let's talk about SoFi. SoFi, another stock that I own. SoFi, a stock that I find expensive now, but I'm not mad. You know why I'm not mad that SoFi is expensive? Because I remember covering this stock in 22, in 23, in 24, and it was, $7, $8, sometimes $6, sometimes $12. I cannot think of a stock more deserving of this spike than SoFi. As you can see, this is the 5-year chart. SoFi deserves its spike, and SoFi is firing on all cylinders, just like it has in the past, except that for some reason the market has started to recognize that SoFi is doing well right now. And during, of course, peak interest rate hikes, that was not the case. And I think a lot of that rise is due to the interest rates dropping. The market recognizing that SoFi is going to make more loans. They're going to make more loans if interest rates drop. And keep in mind, lending personal loans, student loans. It's a very interest rate driven process. The lower your interest rate, the more you're going to lend. And SoFi pretty much grows at the speed it wants relative to the risk they want to take, because it's often assumed in banking that people always want to lend money. So Their business model, though, is borrow money, not lend money. Their business model is the one-stop shop. The idea that if you get somebody, say, for a student loan, they will maybe invest stocks with you. They will maybe get the credit card, maybe get the bank account. So that's the idea of a one-stop shop. And this quarter, they had cross buys in the fourth consecutive quarter. Cross buy increases 40%, up from 35%. So enormous cross selling. This is a stock, like I said, that was hurt by high interest rates, right? And so they've been trying really, really hard to increase their fee-based revenue. Fee-based revenue is now 43% for SoFi. My anticipation is that as the rates drop, that fee-based revenue as part of a revenue mix might actually go down because they will see more demand for loans. People want to borrow money when rates are low. If you look at the revenue, the products, so their members, the funnel, the top of the funnel is the members. They've been adding more and more members. Then they sell more and more products to these members. Adjusted revenue is following closely the member count, and adjusted EBITDA, of course, is positive and growing growing pretty darn fast. I don't want to say even faster, but it's growing pretty darn fast. It's only green flags on this company, in my view. One final thing is tangible book value. That's a traditional metric that a lot of banks use to value themselves, and they're growing that tangible book value very fast. Buffett, for example, is a big fan of tangible book value, so they have to report it is based on their sector. And of course, the last thing I'll point out is the credit quality. So the credit quality, of course, is important. The 57% of that revenue, which is based on lending, right? You got to take into account that some of these loans are going to go into default, and you need to be able to kind of quote-unquote eat the loss, and this is why this is so important. The charge-offs, you can see they've been getting better and better at underwriting, under 4% of loans in default, and that's because they are very picky in who they lend to. They want a FICO score in the 750s, right? 745, 773 for student loans, 745 for personal loans. So they lend to the highest credit-worthy borrowers. If they have a borrower who's not the most credit-worthy, oftentimes they will unload that risk to a partner, and then they will earn servicing fees. That's pretty much how SoFi does it. Now, how expensive is the stock? I mean, it's above 0.5, so I don't like it as much at these levels. I'm not adding at these levels, but I still have my full position. To me, to add to this stock, I would like to see it below 20 to add to it. So to me, this one has started to run. This is not a stock I'm actively adding to. Unlike TransMedics, for example, which I consider still cheap and that I would still consider adding to. SoFi, not the case. I think it's probably going to keep running as the rates drop, and I'm happy about that because I have a full position. I've been in this stock for a very long time now. The last stock, former channel darling, which was killed by interest rates, is Enphase. Enphase was, of course, a company that used to be doing very well when two things were happening. You had the tax credit for solar, and I'm talking 2021 here. You had the tax credit for solar, and you also had very, very low interest rates. So this company went, and you also had NEM-free, which was feed-in tariffs. So you had a lot of people actually, especially in California, making a bunch of money reselling electricity to the grid. So this company was very hot for many years, actually being a top 10 S&P 500 performer, and my view is that it was killed by interest rates because all of a sudden a solar system that you would have on the roof financed at, 4.95%, all of a sudden you started getting financing offers at like 13%. And so people stopped simply buying solar, add the feed-in tariffs, the end of the feed-in tariffs in a lot of states, and you had a recipe for a disaster as far as the revenue dropping. And sure enough, if you look at the performance, I mean, we've recovered from last year. Last year was likely the bottom for them in terms of revenue. We've recovered, but just slightly, just a tad. This is a very, very, very small recovery compared to 3 years ago when this company was booming. So this company So, killed by interest rates, that's the first culprit. Then there's other issues. Another issue, of course, is the battery. A lot of these battery components are imported from China. And to me, the bigger issue to me now is Tesla. I now see Tesla as a clear competitive threat. I made this video exactly a year ago. Tesla versus Enphase, is Enphase a real threat? And my conclusion in this video is that, yeah, Enphase still has a few things going on, like it has a 25-year warranty on the inverters, but you see they don't have that on the battery. The battery is only 15 years. They have, of course, the advantage of a panel-by-panel control with the microinverters. I love the technology. I think the technology of microinverters is a superior technology, but unfortunately, I think the Powerwall kind of put a nail in the coffin, if that makes some sense, because the Powerwall used a very hybrid approach where they do use a string inverter. So it's a central inverter that you put in the garage, but that string inverter has 6 inputs. So you're not talking about the inverter from 15 years ago from like SMA or some German company who only had 1 input and you had to put 12 panels in series, right? You're not talking about this anymore. You're talking for your typical 12-panel install, you're talking about 2 panels being in series. So essentially it's a set of panels. The fact that they designed the string inverter with 6 inputs, in this video I talk about this as kind of a no-brainer. And the problem with that no-brainer is that, of course, the Powerwall 3 comes with the inverter native. It comes with a string inverter natively. So whereas in the past, a lot of owners wanted to buy the Powerwall and pair that with Enphase microinverters, today there's no reason to do that because the marketing innovation of Tesla is that they packed everything together as just one product and it comes with an inverter. And if you don't use that inverter that comes in the Tesla Powerwall, well, you're pretty much throwing away $2,000 to $3,000 because you're not using that inverter. So cross-selling is getting more and more difficult for Enphase. And the bigger problem of Enphase, in my view, is that they've bet on chargers, electric car chargers. And the problem is that, what do we know about electric cars? We know that the brands competing against Tesla are not doing well at all, either in Europe or in the US. Look at Q3 of Tesla. Model Y is yet again the best selling car in Europe, yet again. You know, all it took was Elon Musk to stop being involved in politics and the sales bounced back. So if we move into a world where electric cars mean Tesla cars, all of a sudden, if electric cars mean Tesla cars, if you have a Tesla car, you're going to buy a Tesla product. And add to that the fact that they're launching a panel solution, a solar solution that they're going to manufacture at scale in the Midwest over there at Tesla. And you get a recipe for a very, very, very steep competitor in Tesla. So I love microinverters. I think they're an absolutely wonderful technology. But at this point, Enphase, in my view, is not ready to run. In my view, there needs to be a few things to happen for Enphase to run. First of all, you need to see the competition of Tesla actually start selling some cars. So people want to buy a quote-unquote neutral charger. Then you need to see interest rates go down quite a bit, and you need to see real estate make a comeback. Real estate has been kind of dead for a few years. So if real estate's not doing well, solar panels like Enphase, which is the premium player, is not going to do as well, right? And you need to see perhaps some of these incentives coming back, and that I don't see coming anytime soon. And some of you may tell me, oh, well, wait a minute, because we all remember this stock being $150, right? Or 120 or 150, it was trading this high, and you may be like, okay, well, it was 150, now it's 31. Oh my gosh, it's a steal, right? The problem is that the growth is gone. I put forward revenue growth here next 12 months 4%. The reason why I put 4% is because I'm being kind and I'm using this year's trailing number. Analysts, if you look at the number of analysts, they're actually predicting a decline of 16% in their sales. Now, I think that number is wrong. That's why I'm using 4%. But, even doing that, you see in my spreadsheet, it doesn't work anymore. It's a 1.93. You have no growth adjusted value whatsoever in Enphase. And so you may say, okay, well, thinking like a value investor, putting a value investor cap, let's calculate an earnings yield. So let's calculate an EBITDA yield, kind of a pseudo earnings yield. And what do we get? Do we get a 7%? You have a 7% earnings yield. That's absolutely no good. That's not very high. This is still an expensive company if you were to wanna not put a growth premium in the company. So I think this company still has a very high growth premium embedded in the stock price, and the company unfortunately is not growing at all, and the interest rates are not dropping quite fast enough. So I mean, it could be in for a rebound, but for now this is not a risk that I want to take. As I exited Enphase, I believe it was between $70 and $80, like $77 or something. That's when I exited the stock. Not too much damage after all, but at 31, now it kind of sucks. So anyways, so Enphase for me is no good at this point. Anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.